Effective May 1st, 2026, the United Arab Emirates is officially leaving OPEC and OPEC+. The move marks a hard rejection of the cartel's collective quota system. Instead, the UAE is pivoting to a national strategy driven by regional instability. This departure breaks decades of historic cohesion among global oil producers, stripping away the bloc's leverage and shifting the balance of power in energy markets. The UAE possesses the most diversified economy in the Persian Gulf, yet it still depends heavily on the world's seventh-largest oil reserves. Historically, it has operated within OPEC's business model, enforcing production cuts among members to create artificial scarcity and defend price floors. But that model now conflicts with the UAE's immediate financial requirements. Recently, Abu Dhabi requested swap lines from the U.S. Federal Reserve, signaling an urgent need for liquid dollar capital to stabilize its domestic banks. This animated chart compares the UAE's current production limits against its independent targets. Under the cartel, output is capped at roughly 4.05 million barrels per day. Alone, the UAE intends to scale to 5 million barrels per day by 2027. A restrictive quota system no longer serves a nation that needs to pump and monetize its primary natural asset to meet its sovereign obligations. Beyond liquidity concerns, the UAE is navigating a surge in regional instability that threatens the physical movement of its oil. This map highlights the Strait of Hormuz. An ongoing United States blockade of this maritime choke point has severely crippled trade routes out of the region. This blockade has triggered secondary crises. Iran's economy is under severe strain, and as this image shows, its circular storage tanks are reaching their physical infrastructure limits, leaving the country with nowhere to put its backed-up crude. For the UAE, remaining tethered to a unified energy bloc in such a volatile region has become an unacceptable economic risk. The departure of a top-tier producer strips OPEC of its ability to coordinate the supply cuts required to dictate global prices. This line graph shows the market's initial reaction. WTI futures plunged immediately following the news before finding a slight rebound. UBS analyst Matthew Cowley noted that this exit weakens the cartel's ability to defend price floors, particularly during economic slowdowns. Without a unified safety net, oil prices now face direct exposure to market panic and regional supply shocks. The half-century era of unquestioned OPEC dominance is fracturing. 3 shifts are now inevitable. The cartel will struggle to enforce price floors, UAE output will rise toward 5 million barrels per day, and price volatility will remain tied to the Hormuz blockade. Global supply will increasingly be dictated by independent, nationalistic producers. The UAE's exit may simply be the first of many.